Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tune in into this episode, number 423, To Sell or Not to Sell, Evaluating Your Rental Property's Role in Retirement. But before we get started, I like to start the day by renewing our mind. This verse comes to us from Isaiah chapter 55, verses 8 and 9. For my thoughts are not your thoughts, neither are your ways my ways, declares the Lord. As the heavens are higher than the earth, so are my ways higher than your ways, and my thoughts than your thoughts. And then something fun for the grandkids. Why did the Easter egg hide? It was a little chicken. In today's podcast episode, I want to explore how to evaluate if it makes sense to sell a rental property. Many people we have served over the years own rental properties, and rental properties can be a great tool for retirement because they generate predictable inflation-adjusted income. However, rental properties can have their drawbacks as well. In today's show, I'm going to share the process that we use to help people evaluate if they should keep or sell a rental property from the perspective of retirement cash flow. With interest rates on fixed income being so low for so many years, it had really been hard to justify selling a rental property. But with fixed income interest rates increasing and the appreciation of real estate starting to stall as a result of higher borrowing costs, the analysis is changing. As always, articles, links, and resources are available at soundretirementplanning.com. Just click on episode number 423. Here are a few fun quotes about real estate investing. Will Rogers said, "Don't wait to buy real estate and wait." And Mark Twain said, "Buy land, they're not making it anymore." Before we evaluate the sale of a rental property, let's talk about the pros and cons of owning investment real estate. Some of the advantages of rental property in a retirement financial plan are, number one, it's predictable inflation-adjusted income. Number two, it's been historically less volatile than the stock market. Number three, leverage, aka debt, allows you to purchase an asset with as little as 10 to 25% down, and then you enjoy the appreciation on a larger asset base. Number four, depreciation creates an expense that can help you pay less money in taxes during the ownership years. Number five, 1031 exchanges provide a mechanism to avoid capital gains taxes by rolling one investment property into another. And number six, a stepped-up basis allows for taxes to be avoided on the capital appreciation and depreciation recapture of the real estate if you hold the real estate until death. Now, some of the disadvantages of residential rental properties. Number one, you are renting to people, and people can be problematic. I've heard stories of domestic violence, murder, suicide, and people who are cooking meth in the living room, just to name a few. Number two, the state where you reside may lack landlord-friendly laws. Number three, houses require regular maintenance and can be expensive to repair. Number four, the rental market can be dependent on a major employer. If a large employer leaves an area, it can have a dramatic impact on the demand for real estate. Number five, if you're working with a real estate agent on the sale of your property, the commissions you pay relative to your equity can be quite high. Number six, when you sell rental properties, you may have to pay capital gains tax, state or county excise taxes, and you'll likely have to pay taxes on the recaptured depreciation. And number seven, if you need cash in a hurry, owning individual real estate is not as liquid as other investments such as stocks, bonds, mutual funds, and ETFs. As we prepare to analyze the sale of a rental house, let me give you a list of the information that's going to be needed to complete the analysis. Number one, what is the current value? And we like to use Zillow and Redfin as a starting point. Number two, determine the cost basis. The cost basis is what you paid for the house, including fees associated with the purchase, plus the expense of any major improvements, and then subtract any allowable depreciation and casualty and theft losses. Number three, how much of a mortgage do you have remaining on the property? How many years are remaining on the mortgage? What's the interest rate, and is it a fixed rate or a variable rate? What's the monthly payment? Does the monthly payment include taxes and insurance, or do you pay those expenses separately? Number four, when did you purchase the property? How many years have you owned it? The next several items you can find by reviewing Schedule E in your tax return. What is the gross rental income? Gross means what's the total amount of rent you charge. Number 6, what are the total annual expenses? And this will include things like advertising costs, property management fees, cleaning and maintenance, repairs, supplies, taxes, and insurance. The total expense on Schedule E will include depreciation expense, but for the sake of this analysis, we will break out depreciation and account for it separately. Number 7, we're going to want to look at depreciation expense. Depreciation takes the value of the structure at the time of purchase, not including the value of land. And then in most instances, you will take depreciation expense on the structure over the useful life of the house, which is 3.636% each year for 27.5 years. Once we have this information, we can begin to evaluate the numbers. The capitalization rate, or cap rate, of a property can be determined by dividing the annual net operating income of a property by its value. You can think of the income that is generated as the yield over 1 year. The expectation is when interest rates are increasing, cap rates would also increase. So let me give you this hypothetical scenario. A question an investor would want to ask is, why would I want to take on the risk of owning residential real estate investment with a 4% cap rate when you could enjoy risk-free return in a CD or a money market account that's paying 5%? And I'll give you an example here using simple numbers. Imagine you had $100,000 to invest, and you could purchase a rental property that has a cap rate of 4%, meaning your net income is $4,000 per year. Or you could take that $100,000 and purchase a CD at the bank that's paying 5% per year. This means your net income from the CD is $5,000 per year. An investor is only going to want to take on the increased risk of owning real estate rental property if they believe that there's potential for greater return than that which is available in a safe investment. Now, of course, the return on investment is a function of both yield and capital appreciation. If you expect home prices to, say, increase by 3% per year, then you could say that your rental house would have a 7% total return, 4% as yield or net income, and 3% as appreciation. How much appreciation you can expect from real estate will depend on the location and the market conditions, but it is wise to remember that housing appreciation has enjoyed massive gains over the last 30 years in many parts of the country, in part due to a falling interest rate environment. As rates dropped, it made real estate investing more and more attractive, driving up prices because people were buying a house based on the monthly payment they could afford. But now we're in a situation where interest rates are increasing. We went from 30-year mortgage rates from around 3% to nearly 8%. As rates increase, we would expect housing prices to level off or possibly even decline. But the other thing that makes real estate tricky is that it's not just about interest rates. Supply and demand and economic conditions all play a role in the potential for real estate prices. A conservative short-term investor who's concerned about the short-term results of an asset would expect housing prices to come under pressure as interest rates rise and the economy slows. If a rental property has risk associated with it and the investor has a 4% cap rate, but they want a 5% or 6% cap rate, the seller would either need to figure out how to increase the net operating income by decreasing expenses or increasing rents, or by lowering the selling price to make the cap rate attractive to the investor for the risk that they're assuming. Now, the cap rate can be a little misleading when trying to compare your real estate investment to other types of investments, because if you're considering selling the rental property, you would want to understand how much income you're generating based on the net asset you would have remaining if you sold. So here's an example. If you were earning a net income of $4,000 per year on a $100,000 rental property, we would say that you have a 4% cap rate. However, if you decide to sell your $100,000 rental property, you will likely incur fees, commissions, and taxes. To understand if it makes sense to sell the rental property, the first thing that you're going to want to do is calculate your adjusted cost basis. We will assume that you purchased this property for $50,000 10 years ago. The purchase price assumes the value of the land was $5,000 and the house was $45,000. Then, when we calculate how much depreciation expense we incurred over the last 10 years, we divide the $45,000 by 27.5 years, which means that every year we would have claimed $1,636 of depreciation. Over 10 years of owning the property, the total depreciation is $16,363. Now we take the amount that we paid for the property, which was $50,000, and we subtract the depreciation we claimed over the 10 years, which was $16,363, which will give us an adjusted cost basis of $33,637. Okay, so now that we know our basis, the next step is to evaluate the sale of the property. So let's say I'm going to sell my rental property for $100,000. Now we have to subtract out the selling cost. And so in this example, I'm going to assume 10% or $10,000. The selling costs includes 6% for working with a real estate agent and 4% in miscellaneous expenses, such as staging, post-inspection repairs, title insurance, excise taxes, and attorney's fees. Now, my net selling price is $90,000. The next step is to take your net selling price and subtract the adjusted cost basis, which was $33,637. And that's going to give us a gain. So $90,000 is the net selling price minus the adjusted cost basis of $33,637. And that gives me a taxable gain of $56,363. One thing I want to point out before we calculate the tax is that most people might think they have a $50,000 gain. They bought the property for $50,000 and they're selling it for $100,000, but that's not correct. The gain is your net selling price minus your adjusted cost basis. So the gain, after taking into account costs and depreciation, actually is $56,363. The next thing we want to calculate is how much tax you will owe. To calculate the tax, we need to realize that there are two different types of taxation that will apply. The first tax is on the depreciation recapture. The second is on the long-term capital gains. Remember, we held the property for 10 years, so the depreciation over that time was $16,363. We then take our gain of $56,363 and subtract the depreciation of $16,363, which is $40,000. Because we held the property longer than 12 months, we will enjoy long-term capital gains rates. And in this example, we'll assume the capital gains tax rate is 15% on the $40,000 gain. This gives us a long-term capital gains tax of $6,000. Next, we need to calculate the taxes on the depreciation recapture. The tax rate for depreciation recapture is your ordinary income tax rate up to a maximum of 25%. But in this scenario, we will assume that your tax rate is 22%. So we take the depreciation of $16,363 multiplied by 22%, which gives us depreciation recapture taxes of $3,600. So your total taxes are $6,000 of long-term capital gains and $3,600 of depreciation recapture for a total tax of $9,600. Now that we know our tax liability, we can take our net sales price of $90,000 and subtract out the long-term capital gains tax and the depreciation recapture of $9,600, and the net proceeds available for investment would be $80,400. Now remember, in this example, you were enjoying $4,000 per year on the rental property, which was valued at $100,000. But retirement's all about cash flow. Because we sold the rental, we only have $80,400 remaining to work with. In order to earn $4,000 of income on $80,400, we would need a yield of 5%. 5% of $80,400 would produce $4,000 per year of income. Now that we know the replacement rate of 5% based on the net assets that we have to work with, we know that we would need to earn 5% on $80,400 just to keep the same $4,000 per year of income coming in purely from a cash flow replacement perspective. But remember, the rental house was also appreciating each year with an appreciation rate of 3% on a value of $100,000 asset. Not only do we need to earn 5% for the same cash flow, but if we want our $80,400 to grow beyond the income it's producing, and let's say we want a 2% capital appreciation growth rate, it would need to earn 7% per year, 5% yield plus 2% capital appreciation. To have a guaranteed cash flow of 5% may be doable in today's interest rate environment with low-risk certificates of deposit or money market accounts, but it's not reasonable to find a CD that's going to pay 5% and also grow by 2% per year. Now, keep in mind that this is a 7% return on a smaller initial dollar amount, and the rental income is typically adjusted for inflation each year, while the interest earned on your investment would only be dependent on the rates that are available in the market. If you choose not to sell the rental house, your heirs would receive step-up basis and avoid paying depreciation recapture or capital gains taxes. You would continue to enjoy inflation-adjusted retirement income with a cap rate of 4% per year, as well as the opportunity for the larger asset to continue and hopefully enjoy capital appreciation of 3% per year. Now, if you're interested in understanding the historical rate of appreciation for a specific location, you can use a tool like neighborhoodscout.com. It's a report that you would have to pay for, but it can show you how homes have appreciated in your area over time. I ran the report for my neighborhood and was surprised to see that from the year 2000 through 2023, homes had appreciated at a rate a little bit greater than 4% per year. So as you can see, the decision to sell a rental property has a lot of moving parts. Sometimes people don't care about cash flow, rate of return, or tax implications because they've had bad renters, or they're tired of the work associated with all the upkeep of owning a rental property. In those instances, you're just trying to reduce frustrations and simplify, and it may be more about optimizing life from that perspective. In other cases, if your rental property is producing a good portion of your cash flow in retirement, you're going to want to see if you can replace the cash flow with the net proceeds available after fees, expenses, commissions, and taxes associated with selling the property. In summary, the cap rate is a helpful tool for understanding the potential return on your real estate investment from an income perspective. However, it should not be solely relied upon when making decisions about selling or keeping a rental property. Additional considerations such as fees, commissions, taxes, depreciation recapture should also be taken into account to truly understand the financial implications of selling a rental property. Ultimately, the decision should be based on your individual financial goals and priorities and financial plan. Remember, owning rental property can provide both cash flow and potential appreciation, and holding the property to death avoids long-term capital gains and depreciation recapture taxes. So carefully weigh all the factors before making any decisions. Be sure to consult with a financial advisor, CPA, and real estate professional before making any decisions about selling a rental property, and understand how all of these pieces work within the context of your retirement cash flow plan.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.